Hi, everyone. We're still waiting for some people to trickle in, but happy Friday and even happier with a 3-day weekend coming up. I don't know about you guys, but very excited for that. Yeah, thank you so much for joining this Friday's session of On the Grid. This is our weekly virtual event series where we bring in industry experts to talk about different topics of entrepreneurship. So, if this is your first time hearing of us, we are Grid 110. We are a nonprofit focused on supporting early stage entrepreneurs in Los Angeles, and we primarily do that by running no cost, no equity accelerator programs and providing free resources and workshops whenever we can. So today we are super excited to have Alexis with us. She's an investor at Capitalize VC, and she is here to talk all about sharpening your pitch and building a fundraising plan that aligns with investors. So, Alexis, thank you so much for joining us today. I'll pass it over to you.
Yeah, awesome. Thank you, Estelle. I'm going to go ahead and share my screen here. It's really wonderful to be with you all today. I'm Alexis Dulan. I'm an investor at Capitalize VC. I'm excited to walk you through how to go from idea to investment by building a strong brand, validating your product or idea, and creating a strategy for growth that attracts the right investors. Whether you're just starting out or you're deep in fundraising mode, I'm really keen on making sure you walk away with some tangible steps to move forward. So a little bit more about me. I went to Spelman College in Atlanta, Georgia. I also studied abroad twice in two parts of Spain. I went to Madrid and Malaga. I was an international studies and Spanish major, and transitioned into consulting. I worked at Accenture, based in LA for several years, and the Washington, D.C. metro area. I then started working at Slack, where I worked as an experience specialist, really got an idea of what tech meant, and went through that acquisition through Salesforce, which was really exciting. But then I was like, well, how did Slack become Slack? That doesn't make any sense. Like, it's only 6 years old. It's a billion-dollar company. How does that work? And that's when I learned about venture capital and fundraising and growing your business really fast to match the scalability of your customer base. And so from there, I did a fellowship program called HBCUVC, that introduces students from HBCUs to venture capital. I interned at a fund called Foundry Group, based in Boulder, Colorado. They've invested in funds that you know of, like Slauson and Co., Cake Ventures, other funds with emerging managers who look like us. And then from there, transition into venture, working at a Series A and a Series C startup, and then now at Capitalize. I've got some interesting education in venture through VC University, and I also did the Venture Deals program. And I support several fellowships and volunteer with Goody Nation, HBCU VC, Black VC, Venn Capital, 500 Startups, and then HBCU Founders Initiative. So just wanted to give you a little background to know who you're talking to, how I got into the space, and so you can understand why I'm the right person to give you some information today. So I know this agenda looks pretty daunting, but we're going to cover a bunch of topics, really startup funding fundamentals, building your founder story. So I know a lot of you probably have a why as to why you started your business. And a lot of times when people go to fundraise, they take that part out. And it's really important to include that in. Customer discovery and MVP testing, defining key metrics and market potential, getting into unit economics and modeling. And then we'll talk a little bit about funding your ask, creating an investor-ready pitch deck, and we'll wrap with some actionable funding strategies, including grants and accelerators. To kick us off here, would love for everyone to hop in the chat and talk to me about how confident you feel about raising capital with your current business setup. You can go from very confident to not confident at all. And if you're just here to listen, you don't have to share in the chat, but I'd love to get a poll to see how everyone feels about their current fundraising plan. Okie doke, let's check. 8 out of 10, confused, somewhat confused, confident, confident, tightening up my story. Okay. Somewhat confident, not confident at all. Oh yeah, and don't forget to drop your company one-liner, if you can. Somewhat confident. Okay, so we're getting like somewhere in the middle between kind of confident, a little confident, and I'm just here because I don't know anything at all. And that's great because I have plenty of things to share. So continue, okay, service based, so not high growth, not VC competent, but we'll get into other areas or other ways to fund your business. I just happen to work in VC, but I've worked with companies with a broad range of backgrounds from services to consulting to tech. So happy to answer any specific questions that you have there too. So let's continue on. Um, let's talk about the fundamentals of funding. So let's start with kind of the basics here. Um, what does it mean to fundraise? I think it sounds pretty intuitive that you're trying to get money. But fundraising can be a lot of different things. But fundraising is really getting those financial resources that you need to be able to build your business. And it's really crucial for early stage development. Some folks bootstrap, so you have your own savings. You use that money to build the early stages of your business, which is pretty common. Some people have friends and family who will give them a loan or give them $10,000 to get their idea off the ground. And some people have to go out, get a loan, or actually raise venture capital to get those early stages of their business started. Fundraising is really important because it allows you to buy time to prove traction. Most early stage founders who you all probably identify as raise enough to reach your next fundable milestone. So typically when you're fundraising, you don't want to just fundraise to get the capital to get started. You also want to fundraise to give yourself enough time to have some runway. So typically 12 to 18 months of runway is acceptable. And for example, if your goal is to launch a beta product and reach 1,000 users, you want to raise just enough to hit that target, not to fund 3 years of operations. So there are different fundable milestones that we will talk about. And typically that aligns with different product or services goals that you have. But we really want to tailor it to whatever your specific business is. And that will help us really identify how you will set up your fundraising strategy. So let's go to the next slide. Let's talk a little bit about your founder journey and narrative. So we're all here because we had this idea that resonated with us, that we felt compelled enough to turn it into an idea that could be a business. So as an investor, when I'm talking to early stage founders, we invest in very early stage founders, I want to know your why. And I also want to know why you are the right person to build this business. So if you're building a business and you say, I am creating a new ice cream for non-dairy ice cream consumers, but you have no experience in the space, you don't particularly like ice cream, and you generally don't have any idea about why ice cream needs a new flavor, I'm going to kind of question why you'd be the right founder to build this business. But if you say, Alexis, I am lactose intolerant, I've struggled to find ice cream brands that have the right flavors that I like. They never have the right alternatives in terms of dairy products. I think that I would be the right person to build this business because I've been struggling with this for 10 years and I think I have the right solution. Those are the things that you want to include in your narrative that make me as an investor think, okay, there's a clear problem here. She has the right solution. And she's the right person to build this out because she actually has some skin in the game to see this problem solved. And so when we talk about founder journey and narrative, that is what we want to hear And that is part of your story as you're telling investors, um, close friends, anyone who is looking to support you in your business. So let's move to the next slide. Problem definition and solution validation. So this is a little bit kind of diving a little bit deeper into why in your investor deck. So one of the things that's really important is really being able to define what the problem is. So identifying the specific problem that your business solves. Even if, as I mentioned, an ice cream company is what you're building, if you have a CPG brand, there has to be some sort of reason why or some sort of problem that you are solving by creating this brand. What is a solution validation? Have you done customer interviews? Have you put the product out to market and you sell out every time you go to a farmer's market? Are you providing services and your customers are seeing ROI? Do you have a tech solution that is solving a major problem for people who are using the platform? That is something that we want to see in your solution validation. Your MVP approach. So that's also very differentiated depending on the type of business that you have. Um, we want to see how you're testing it in the market. And for very early stage companies like you all's, those key ways that I mentioned, like selling out at a farmer's market, providing an ROI for your clients, being able to use a platform for your different enterprise customers that is solving a problem for them, and then being able to share that back and you continuing to grow your business is really important for that MVP approach. And then the customer discovery. So for a lot of you, if you're not ready to go to market yet, conducting those customer interviews to really understand your customer needs is really important to being able to understand if your solution is actually solving the problem. One of the things that I always went back to when I was working at early stage companies is a product feedback channel from my customers, because you can build the most amazing business, but if your customers are not seeing an ROI, if they're not buying your product, it doesn't really matter, right? So that customer discovery is really, really important because they are the ones who are really going to make you successful. Let's go into some more details around key metrics and market research. So key metrics that we like to talk about, that you should include in your discussion with investors. Um, how are you thinking about measuring success? Willingness to pay, particularly for tech founders, for CPG founders, is really important. Services businesses, you have a bit of flexibility because oftentimes you can negotiate what your rate is with different clients. But when you have a CPG brand, or if you have a tech company and you're charging a platform fee and a SaaS fee that's set, you want to make sure that you are setting your metrics or your business model at a rate where you think your customers will actually pay and that they will actually renew once their contracts are up. For your services businesses, it's really important to talk to your customers about their budget and really kind of think about a timeline that works for them to be able to afford to pay for your services over a period of time. Um, Market size. So for those of us who are looking to start our CPG brands and our tech companies, and we're trying to grow into a large market, it's really important to understand what that target addressable market is. For a lot of investors, particularly on the VC side, they won't touch a specific company if they don't feel like it's large enough for you to actually take a certain percentage of it. So for us at Capitalize, we're looking for a minimum of $1 billion market size. If you're not able to kind of capture 1% of that, that's not going to be something that we're going to want to look at, because we have to hit certain returns as well. We want to see you succeed, but for venture, by definition, we're looking for scalable, fast-growing companies, and that market has to be able to match that scalability and that growth. Again, the customer discovery, this can also be tag teamed with your traction. So for those of you who are already in market, you're maybe beyond those customer interviews. You may be able to say, hey, we've sold 100 uh, 100 cases of ice cream each month for the past 10 months, and this is how much revenue we've made. Or we're growing at 20% month over month. Here's how our revenue is growing. And you can include customer sentiment in that traction slide, but those numbers are really going to tell the story of how your product, your service is really growing based on that customer sentiment. And then the serviceable market, this kind of ties into the market size. How much of that market are you actually going to be able to attain? And we'll be able to kind of match those things together as we look at your financials, and see how you're growing to actually attain that percentage that you're going to get from that TAM. So I really want to kind of dive into a little bit more here, but just circling in on the market, the customer, the willingness to pay is really going to tell the investors whether or not what you're building is something that is actually going to scale. And here is the proof with my customers to show that I'm actually scaling and growing and capturing some of that market. So understanding unit economics, and I promise you we're going to have some time for questions. So please write them down, get them ready. These are just a few. There's so many. So I just wanted to give you guys a highlight of some of the ones that are most important, particularly from the venture capital side. Really wanting to understand, particularly within your financials, your customer acquisition cost. How much money are you spending to acquire one customer? And over the lifetime of that customer being your customer, how much money are they spending? So was it worth it for you to spend $5 on a customer if they've only spent $2 with you, right? So we want to understand that ratio. If you spent $5 on a customer, but they've spent $15,000 with you, that's amazing. And those are the things that we want you to communicate to your investors so that we can understand how viable your business is and how you're able to grow with minimal costs. Gross margins. This is really important, particularly for my CPG folks on the call. I want to understand how much it costs for you to make your specific product and how much you're selling it for and what the margin is that you're capturing from each product. That's really important. And I know that a lot of us on the call who are CPG founders are thinking about tariffs and how that's going to impact the costs associated with your product creation. That's something that's also needs to be factored in. So when you're thinking about your gross margins and you're thinking about tariffs, how are you factoring in that tariff cost to and what does your margin now look like if you're trying to make sure that your customer is not going to feel the brunt of that tariff, but you're also going to be able to turn a profit on each of those products. And that's something we can dive a little bit deeper into is how policies impact your gross margins. It just so happens to be like a really like main topic of discussion across the CPG and retail landscape. So that's something that you guys are probably thinking about that we can talk about as well. LTV, talked about that a little bit, but what is the total revenue generated from a specific customer throughout the relationship with the business? I know you guys are probably thinking about your most loyal customers. One thing that I'll say that I always see is that some folks are so busy trying to acquire new customers that you forget about the loyal customers, those customers who've been spending money with you for years. You got to make sure that you maintain those relationships too, because those are the folks who are going to, especially for my CPG folks, even though you don't talk about ARR because that's more of a tech term, that kind of is your ARR. If you have a loyal customer and they constantly spend $1,000 a month and you can count on them spending $1,000 a month, That's revenue that that you can build into your model. But if you are not managing those relationships, you might see that $1,000 dwindle. So when we think about LTV, we think about that relationship with that specific customer, how much it costs you to acquire them, and how much revenue they're spending with you over time. So some unit economics, as I mentioned, it varies by industry. So SaaS companies often have a high LTV relative to their CAC. But and mostly CPG companies have a lower LTV relative to CAC. Your CAC is a bit higher to acquire customers. Some of the things that can help you reduce those costs are using social media marketing, other types of marketing where you're not actually having to spend money to get to your customer base. But overall, if I'm logging on to Slack, and I get a couple folks from my team to log on to Slack, that didn't cost Slack any money, right? But if I'm trying to sell a specific shampoo and I'm at a farmer's market, I have to make sure that I have product available. So I have to spend money to create that product. And I have to make sure that I have product available to sell to the customers and see if they actually want to buy it, right? So I'm only going to see that margin. And then lastly, contribution margins shows your revenue remaining after variable costs. So this is really critical to understanding how much revenue contributes to fixed cost and profit generation. Awesome. So again, I know we probably have a ton of questions, but going into what I think, especially for CPG founders, is one of the most important things that investors are going to ask for, and that is your financial model. Your financial model not only tells me the financial health of your business, but it also tells me how you plan to grow your business and what are those revenues, what are the revenue projections, and what are those expenses that are going to drive your business, and how is that going to impact your overall revenue. So kind of jumping in, cost structure. I really want to be able to understand your list of fixed costs, your variable costs, a breakdown of your operational expenses, revenue projections. The reason why that one is plugged in is because it's so important to understand how you think you're going to be able to grow. So what is your projected sales forecast? What is your growth rate assumption? And then what is your market size analysis? So one of those things that I mentioned earlier is being able to understand how much of that market you think you're going to be able to attain. That should be clearly documented in your financial model. And this goes for everybody on the call. So revenue projections is important for everyone. Profitability timeline. This is really important as well. Oftentimes, businesses are not operating at a profit initially. But as an investor, I want to be able to see in your projections, at what point do you break even and you start turning a profit from your sales? That's really important. And then financial viability. It's really important for me to be able to see a quick summary of your financial statements. I want to see your cash flow projections and then financial ratios. This is really important because I want to be able to just take a quick look and see if, based on what you're modeling out, if you're going to actually be able to hit those targets that you've set out. So financial model is really, really important. Awesome. So now that you have everything ready, you have your story ready, you have your financial projections ready, you understand the market, you understand your key metrics that you want to include, your business model. How do you actually talk about a funding ask? So the first thing you need to identify is, how much do you need to raise? For your tech founders, if you're pre-seed, maybe you're raising 500K to build a beta and acquire 1,000 users. But what does that mean, right? The funding stages are pre-seed, seed, or Series A plus, and that's for tech companies. But there are also loans. There's non-dilutive capital that you can raise that also is incorporated into your funding stages. How much do you want to raise? And I talked about this in the very, very beginning, but how much you want to raise is typically enough to reach your next fundable milestone. So if you have some key things on your product roadmap, whether that's through CPG or in tech, how long is that capital going to take you? And how much time is that going to last you? What does that timeline look like? Your use of funds. This is really, really important. I want to know what you're going to use the money for. You have to be able to outline what you're going to use it for. So 200K to hire engineers, 100K for marketing, 100K for ops, and 100K for runway. It shows that you're intentional. And then you always want to tie your ask to a milestone. So it gives your investors confidence that you know at the next time that you're going to need to raise. And then I mentioned a little bit about your funding sources. So angel investors, venture capital, corporate investors, and potentially grants and accelerators. So this is a perfect time to get some audience participation. So I'm going to pause here, and I'm going to leave this slide up, and we're going to go into breakout rooms. And Estelle is going to help us break out. You're going to have 10 minutes this for this session. I'll pause here. And I will drop the prompt in the chat as well so everyone can see it.
Paz. Let's see, maybe she stepped away for a second. Paz. All right. Oh, hi, Sebastian.
Hello. Hi. Oh,
Hi, sorry, did you just join us?
okay. Now I'm okay. I'm good now. You hear me?
Okay, yes. Yeah, it looks like we have people in breakout rooms right now. Did you get the invite? I think you're in room 3.
Oh, so actually, what exactly is the recap room? I didn't understand very well. So,
Oh, here, we have the prompt in the chat. I'll post it one more time.
Hi, it's Paz. Sorry, I'm like doing two things at the same time right now. Is it okay if I just step out?
Yeah,
Or
yeah, of course.
yeah, and then you guys will send the recording, right?
Yes.
Yeah. Okay. Thank you so much.
Yeah, of course. Have a good
Okay.
one.
Thanks, you too.
And then Sebastian, let's see. Did you get the invite to your room? right, looks like everyone should be back.
Awesome. Welcome back, everyone. I want to see if anyone wants to share a quick summary of what you talked about in your breakout room. In the interest of time, we'll only do one volunteer. Does anyone want to share?
I'll share.
Awesome.
I spoke with a young lady about what she's working on and some of the things that may present some trepidation or challenges for her. And I just shared what I'm working on, and like we also did a quick exchange about like what stood out in your presentation and what we'd like to sort of accomplish in the next few months. And it was just a good exchange between two people who are attempting to do some exciting things.
Awesome. Thanks for sharing. I'm sorry, I should have asked, can you introduce yourself as well?
Sure. My name is Corby. I'm a plant-based chef based here in Los Angeles. Um, I'm working on a few different projects right now. I'm most likely going to secure a mobile food cart here in the city so I could kind of spread my plant-based food. But I'm also really interested in been learning more about like some food service technology, and I'm interested in implementing some of the things I see going on in Japan. Japan has a lot of like, to my knowledge, one of the innovations in Japan that's really popular when it comes to food is these sort of pizza vending machines. And I see an opportunity in that, presenting not necessarily pizza, but other types of prepared foods. The young lady I was in the breakout room with, she explained to me that she was in Nashville and she's observed like these types of machines being uh, pretty much used in Nashville. So I'm in that space right now.
Awesome. Thank you so much for sharing.
No problem.
I'm glad you're here to learn some more about how you can get there. I'm glad you guys were all able to chat with each other in the breakout rooms. It's always great to kind of get the ideas out of your head and validate them with someone else and kind of see how other people are thinking about the same things. And so just to kind of go through this slide really quickly, your pitch deck should tell a story, including the problem, solution, traction, market, model, financials, and the ask. So how much you're asking, right? One founder I advised restructured her deck by also adding a why now slide. It helped to show urgency and market readiness. And the big thing that I want to leave with you guys is less text, more storytelling. Use visuals where possible, charts, screenshots, growth curves, quick anecdotes. You don't necessarily need to have all the text that I have on this slide. It's a lot to read. And your investors probably won't read it. They're more so listening to what you're telling them, right? So there's that. So let's talk about engaging the right investors. One of the things that I think a lot of people struggle with is like, how do I find investors? Who do I talk to? Every investor isn't your investor. So focus on those investors who invest in your stage and sector. Just because I'm a venture investor doesn't mean that I'm the right person who can invest in your business. And most venture investors have a very specific thesis that they follow. And if you don't fit squarely in that thesis, they probably won't chat with you. It's nothing personal, but most of the time, investors have a mandate of what they're supposed to invest in from their investors. So if they deviate from that, they're not really sticking to what their promise is and what the outcome is supposed to be. So here are a couple ways that I think are really great steps to take to get to investor readiness. So investor identification. So putting together a list of all the investors in your space, thinking about their investment history and their interests. Does it align with what you're focused on? Thinking about networking techniques. So I'm on this call. This is technically a networking technique. After the call, I'll give you my information. You can reach out to me. I can connect you with people I know. A lot of times People participate in pitch competitions, social media platforms. I'm pretty sure you heard about this session through social media. It's a great way to find investors as well. Investor fit, again, making sure they fit your focus, your industry, and your funding stage. So if you're talking to private equity investors and you are early stage, probably not the best fit, even though they may have capital for you. Private equity is really, really late stage companies who need that large capital infusion to get to another growth stage or maybe to improve operations, but not necessarily for early stage. And then industry focus, as I mentioned, an investor who invests in your market. One of the things I also want to share is that if you just go to a general investor, that's great, but oftentimes you want to go to investors who are in your specific market because they will be able to actually give you feedback and share resources that are relevant to your business. So, for example, if I'm in fashion and beauty and I get an investor who is in health, maybe they can give me the capital, but they may not have the resources or the connections to help me grow my business in the fashion and beauty sector. This is the slide that I think is really, really important. Equity versus non-dilutive funding. And I won't train the slide, but I will just say equity funding is great for fast growth, scalable startups, which means that, but also means that you're giving up a percentage of ownership in your company. Non-dilutive options like grants and pitch competitions let you maintain ownership, but it's a little bit more cumbersome to fill out those grant applications and to participate in the pitch competitions. One founder won 3 pitch competitions totaling $75,000 before raising a seed round. So you can also think about starting off with non-dilutive capital to extend your runway before you go into equity funding. So just wanted to share this as an option for you guys. Equity funding is also particularly a sticky topic within different communities because a lot of folks are very nervous about giving up ownership in their businesses. So non-dilutive capital is a great way to get capital without having to think about giving away percent of ownership in your business. So equity funding, here are just a few options: angel investors, venture capital, crowdfunding options that do allow investors to take equity, and then corporate investors, so like CVCs, so like L'Oreal has a venture fund, CVS has a venture fund, different banks have a venture fund, and then an IPO. An IPO allows the public to take ownership in your business. So if I have 1,000 shares of Google, I own that percent of the company with my shares. Non-dilutive capital funding. You have grants, which I think we're all familiar with, loans and CDFIs. CDFIs I'll go into a little bit deeper. There are a lot in LA in particular. Pitch competitions, accelerators, and then crowdfunding options. Accelerators, Grid 110 has an accelerator they just talked about earlier on the call. I know Slauson & Co. has an accelerator, and there are other funds in the Los Angeles area that have different accelerators. And then there are tons of pitch competitions that happen across the city and I think across the state. And I'll share a few examples of what those are as well. So let's think about some fundamentals. So for a lot of you who are CPG companies, you need to have working capital. You can't start a business without having a little bit of money to cover your expenses. And working capital is the difference between a company's current assets and current liabilities, basically the money available for day-to-day operations. And here I outlined the working capital ratio, and then the net working capital ratio, which focuses on cash, accounts receivable, and inventory convertible to cash within 12 months. Some of your short-term liabilities are accounts payable, debts, any accrued expenses for salary, taxes, and other outlays. And then healthy working capital ensures that your business can cover those operational expenses and those short-term financial obligations effectively. So this is really, really important. Okay, CDFIs. CDFIs, I really wanted to create a whole slide on this one because CDFIs, especially for small businesses, are really important because they are mission-driven lenders that support founders that are often overlooked by banks. So if you're a founder of color or you're based in an under-resourced area, you can look into CDFIs like the True Fund. I know there's Vermont Slauson, that's right around the corner, and several others in the area that can provide you capital, and they also provide mentorship. I know that Vermont Slauson also has connections with several other organizations in Los Angeles that can provide help with legal services, putting together the pro forma, the financial projections. They can help you get with staffing, a lot of different things that this capital can provide that are really important, particularly for small businesses as you grow and scale. So here are just a few accelerators and pitch competitions that I work with frequently. So there's Y Combinator, which I think is really, really intense. Techstars, 500 Startups, Plug and Play, Google for Startups, and then pitch competitions for entrepreneurs. These are more so tech pitch competitions. There's Startup World Cup, Collision 2024, TechCrunch, Disrupt, Web Summit, and Slush. I have a whole list of others that I'll also include and share with the team that they can send over. But these are really important for you guys to just take a look at. And then lastly, some grant funding strategies. Grant funding is really, really great. And here are some like key ways to kind of think about your grant funding strategy. So understanding the grantor's objective. So this is similar to an investor, but really understanding what the grantor's objectives are to increase your chances of success in the application process, right? Defining your problem. So you've already done this in creating that pitch deck, but really being able to articulate that in your answer is really, really important. The who you're solving for is also really important. For those of you who may have a mission-driven approach to your business, you can include that in your problem definition. Communicating your unique approach, so that's your solution. Showing your impact to society. And if you don't have that, that's fine. But for those of you who have sort of a mission-driven business, that's really important. Your current and future impact. So that could be customer conversations. That could be how much you've done in revenue. Thinking about those financial projections in the same way is important. And then mirroring the grant language in your RFP. So making sure that the language that they're using in their questions is translated in how you're answering the question. They want to know that you're not just kind of doing a rinse and repeat, but you're actually answering the specific question in that application. So that's a little bit about grant funding. And then how can I support? So I work with founders through workshops like these, through advisory and investment. Whether you're preparing for your first pitch or closing a round, I can help you navigate the process. And I've seen what works and I know how to position your business for capital. So I support founders with advisory and mentorship, helping you to understand investment opportunities, workshops and engagements, and then QA sessions. So I kind of sped through the last couple slides, and I know we don't have that much time for questions, but I want to ask and answer any questions you have. I'm happy to stay over a little bit just to answer questions. And I'm here to provide you with any clarity and support for your entrepreneurial journey. So thank you all for your time, and I want to open it up for questions. Hi, Luciano. Thanks for raising your hand. Would love to hear your question.
Yes, just a quick question. You didn't mention it, but it's kind of implied in kind of the different options around crowdfunding or community raise. Like any thoughts on kind of, we're super early stage, so we're looking to do a pre-seed raise. And so kind of as a, I don't know, I'll call it bird seed race before the pre-seed. We're thinking like a community race through crowdfunding, either WeFunder or something like that, as like maybe on the 250 to 500K range, and then eventually do a pre-seed. Just wondering, what are your thoughts on kind of a strategy on how to think about those?
Yeah, that's a great question. So typically we call that a friends and family round. And typically you could raise that on a safe or through crowdfunding. WeFunder is really popular, as you mentioned. What I would recommend in the same way that you would go about doing the investor raise is pulling down a list of a list of contacts or folks that you would like to reach out to, who you'd like to participate. Putting that into a spreadsheet where you're kind of documenting who those people are, how much you think they would invest, and then thinking about whether or not you want them to be able to invest as like here's sort of a grant, or here's an opportunity for you to take a small percentage of equity in my business. So WeFunder has an option where you can pool together that capital, smaller checks, and they have an opportunity to take like 5% of your business. And every individual investor has some small percentage, similar to how, you would purchase a stock. So that's an option for you, but it would be the same process of pulling down a list of people that you'd want to reach out to, figuring out how much you think they would want to invest, and seeing how many of those people you'll need to hit that goal.
Got it. Thank you. So you don't see any issues with kind of doing I'll call it crowd fundraise and then going to some like early stage investor after that, like to see it as one line item on their cap table kind of thing.
Right. So like, for example, with an angel group, that's several investors investing as an angel group, and that's a one-liner. It's just a different vehicle that they're using to invest. So typically angel groups will use an SPV, but if you're using a crowdfunding source, that would just be the line item for that raise. Awesome. Brandon, nice to meet you.
Hey, Alexis. Alexis?
Yes.
Okay. Nice to meet you as well. I'm Brandon, founder of Tutor D. We provide like organizations of non-traditional learning spaces to deliver their curriculum, blah, 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 deliver their curriculum in an accessible way, and provide adaptable learning experiences through SMS technology. We've like generated over $20,000 in like grants and customers and early design partners, but we're looking at like how to approach like investors or angels, but also how do we engage with like larger like VCs as well. So when my understanding of like with their funds, usually they're investing like the first 5 years of the fund, but also when you're engaging with a fund, how do you approach like talking to other port comps and really getting a feel for like that fund and how they manage their process?
That is a great question. Because oftentimes people, and I didn't mention this, there's so much to share. But one of the things you should also think about is, do you like the investor? Is this an investor that you would want to work with for a long term? Because when I invest 250K into your business, I'm going to stick it out into whatever your exit is, right? And oftentimes in our portfolio, we provide opportunities for our portfolio companies to work together. We make introductions to different portfolio companies. The reason why we are CPG, and I didn't really tell you a little bit about our fund, but we invest in commerce, tech, and CPG brands. So the technology that we are investing in can plug into the brands that we're investing in. So oftentimes there's a synergy that's happening between those two founders, right? When you think about you're an investor, is there going to be an opportunity for your business to be able to have that same synergy with their portfolio companies? If you, for example, the reason why generalist funds are great, but it's harder for founders to get support, is because all of the founders are building in very different spaces, and you may be able to connect on the general founder journey, But how about you being able to connect with a founder in the portfolio who can potentially be your customer or a design partner or help you find additional customers? You want to think about your investors as like a dating opportunity. They have to like you as much as you like them. And there has to be some benefit that you're getting out of them and vice versa. And when you think about putting together that investor list, the industry focus, the check size, the stage is important, but also what is their portfolio support process? So whenever you're on your calls, if that's really important to you, at the last 2 minutes, say, hey, what does your portfolio support process look like? How do your portfolio founders work together? How do they work? How do they support each other? That's something that you want to include in your conversation with those investors and in the list of investors that you're putting together as you target fundraising.
Thank you.
Of course. Any other questions? Put my information up here. Oh, here, of course.
Okay, I
ahead.
have some more questions. Um, so with regards to if you're looking at exit strategies, how do you guys look at like the other exit strategies of like dividends or like companies that decide to look at other non-traditional ways of exit while they're still exploring like a traditional exit, like a merger or a IPO?
So we only think about two exit strategies traditionally in venture, and that's an acquisition or going public. There are opportunities if you as a founder are like, I don't really want to build this business anymore, you can bring on another CEO and kind of take a step back. You can For people who are invested in the company, there's also the secondaries market, which is this is kind of more of a nuance where you can sell your equity or your shares in a business in the secondaries market to someone else who may want to have ownership in the business. This is becoming really popular, particularly now as the market has become really volatile. But for me as a VC, what I'm thinking about really is an acquisition target or you going public, because I'm looking for you to 10x and kind of exit at that stage so that I can get a return on my fund.
Okay. And so follow-up question is that I've heard and read that, you want to talk to those potential, acquisition partners
Mhm.
earlier before you're about to, get acquired like 5 years later or 10 or 4 years later. How do you really manage that conversation or re-engage with them to start, opening themselves up, open that conversation door for like that acquisition later on?
That's a great question. And I hear founders ask that a lot. So oftentimes, let's say you're in a niche market or you're building in a space and you're growing really quickly. There are a lot of people, you don't know this, but there are people on teams on at these companies who are looking out for different companies that are complementary to what they're doing. And so they're trying to find new technology that would enhance what they're doing at their company. And so they may be looking at you and you don't even know, right? But they're also looking at your competitors and they're trying to see who is going to be the winner. And if they approach you and say, hey, Brandon, like, I really like what you're building. We want to acquire you for $20 million. And you can say, well, that's great. I want to continue to build. I see myself getting to 100 million ARR. And at that point, I'd want to talk to you about acquisition, right? But you can always just continue to check in with that person and say, hey, we've hit this milestone, we've hit this milestone, or hey, I'm actually considering an acquisition. Are you guys still thinking about that? It's really important, to kind of stay on the top of their minds, like maybe with keeping them in your quarterly newsletter, having a quarterly call with this person, just maintaining a relationship the same way you would maintain an investor relationship. Um, but you also want to just think about, from an investor perspective, I want to know, are you going to be the one who is going to start this business and build it out? And that's what I'm investing in. I'm investing in the fact that you want to stay on and build this business and see what the exit potential is, and not like so quickly thinking about acquisition. So those are kind of like the couple things that I would suggest you think about in terms of that question.
Got it. Thank you.
Awesome. Any other questions?
Hey, I know we're over time, but I do have a question. Hi, Alexis.
Hey.
Yeah, my name is Kevin. Building Spotter. We're building the OS for fitness creators to manage their business and bridging the gap between fitness and healthcare. We just launched in the process of raising, and a lot of the stuff that you're doing that you mentioned, we're trying to implement, do that at a high level. I think kind of taking a step back, what we're facing is how do we get that calendar density and how do we scale up warm intros rapidly enough so that we can fill up that calendar and do everything that you're talking about. I think we got a lot of that stuff in play, but it's like just literally getting in front of all these people. So if you have any questions or thoughts around that, that'd be really helpful.
Yeah, so it's very painful if you're not like into networking, but going to different networking events and meeting some of these investors in person. I know LA has a ton of networking events in the venture space. Talking to folks like Grid 110, I'm pretty sure they have a network of investors that they chat with, who, they'd be happy to do an intro with if you start to engage with them on a regular basis. But really thinking about and scouring LinkedIn, and pulling together a list of all of the potential funds that invest in your space, and thinking about it like categorically too. So, in funds that invest in sports, funds that invest in Black founders, funds that invest in early stage founders, funds that invest in founders in LA, funds that invest. So run down the list and get as many people on that list as possible. Find who works there on LinkedIn, reach out. See, a lot of us, if you go on our websites, we have a form that you can fill out, that where you can do like a cold outreach. So we call it an intake form. We look at every single company that comes through our intake form. Many companies, many funds do, because we're not going to be able to find every founder. Maybe they can find us, but it's really more so like process of elimination. And you can't really be daunted by the fact that you have 500 people on the list, because maybe out of those 500, you get 5 investors, but those are the 5 investors who will fund your round. And so I would say start out with that list of investors, categorize them, find the individual who works there. I always recommend the associate, because the associates like me, we are tasked with sourcing deals. And so if you can find the associate who's looking for deals, they are more likely to get you a call with whoever the decision maker is. And that is kind of like what I would say is the best strategy. And I'm also happy to connect with you outside of this to talk more about what you're looking for. And that's for everyone. That's why I'm sharing my contact information. So
Awesome. Thank you. That's helpful. And I'm glad that you said that drop, because I didn't know that drop on the email list. I mean, on the website. I was like, does that actually work? I didn't know.
yes, we've invested, like a couple of our portfolio companies have come from filling out the form. So yes.
Got it. Got it. And then one quick follow-up. You say reach out. Is that LinkedIn? Is that well, you shared your contact information? Because sometimes LinkedIn, it seems like it can just be a kind of crapshoot as well.
It can be, or it may not be. And what I always suggest is the first step is finding out who that person is, but also saying, hey, is there someone I'm mutually connected to who can do a warm intro? If that person can do a warm intro, then that's my way in. I can hop on a call with that person, or if there are people in the space who are like, hey, reach out to me whenever. Reach out to them whenever. Get on a call and say, hey, you're connected to these 10 investors. Can you connect me to them? Right? You have to be scrappy, be as creative as possible. I think the beauty of entrepreneurship is, you're willing to do what a lot of people aren't. In order to raise, you have to be a little bit more scrappy, find out who the person is, who will connect you to the right person and get that money, right? That's part of, the beautiful part of it is the nice spreadsheet, but the scrappy part is like finding out who the person is and like actually getting them to get on a call with you to talk about what you're building. So, mhm. Any other questions? Awesome. Well, I really appreciate everyone's time and thank you for staying over. There's my contact information, and I'll pass it over to Estelle for last.
Yes, thank you so much, Alexis. That was amazing. And like I said, felt like I was back in college finance class. So thank you so much for coming in and talking about that. And thank you to everyone who showed up. Would love to see you next week. We are having the founder of Tahara Ventures, Mohammed Malik, come in to talk about the science of product market fit. So I just dropped the registration link in the chat, and otherwise have a great 3-day weekend.